Hello, my friend. Welcome to Charlie Retail Invest. Let's follow the latest trend in US economy and share our recent investment in stock and bond markets. The most important thing for this week is undoubtedly the FOMC meeting from September 17 to 18. After this meeting, the Federal Reserve Chairman Jerome Powell will announce Fed's pivot from quantitative tightening to quantitative easing, and the Fed will start cutting interest rates. As of last week, market expected the Fed to cut by 1 basis point, which is 0.25%. However, by today, September 17, market weighs heavily the possibility of 2 basis points cut by the Fed, which is 0.5% cut of the benchmark interest rate. The possibility of this happening has risen to 60%, whereas the 0.25% cut scenario has a probability of 40%. The change in market expectation is mostly due to the recent data suggesting that the US economy is slowing down significantly. Inflation rate CPI has continued to decrease to 2.5% in August of this year, and CNBC reported that job cuts reached a total of over 75,000 in August, which is 193% higher than July. It was also the highest number for August, going back to 2009 during the global financial crisis. Analysts expect the overall unemployment rate to reach 4.5% by the end of this year, which means we are most likely only 6 months away from a recession. As a result, Federal Reserve needs to take quick measures to cut interest rates, and multiple rate cuts are necessary to stimulate the economy. If the Fed is too slow, unemployment rate can shoot up to over 7% in 2025, and we may even head into depression territory. The CEO of JP Morgan, Jamie Dimon, recently suggested the possibility that the US economy may head into stagflation, just like the 1970s. This is because the debt of the US government has increased dramatically since 2020, and it now reached over $35 trillion. If the Fed cuts interest rates significantly to stimulate the economy, inflation might surge back again, and the purchasing power of US dollars would be slashed really hard. If that happens, the Fed will have to stop cutting interest rate and go back to hike interest rate to fight against inflation, just like what they did in 2022. As a result, companies in the US would find it really expensive to raise capital or borrow money, and they will have to continue laying off workers to reduce operational costs. This will contribute to both high unemployment rate and high inflation, which is even worse than a recession. As we discussed in our video on September 11, we expect the Treasury bond yield to continue to drop in the next 6 to 12 months as the Fed starts cutting interest rates. When bond yield decreases, bond prices will increase during the interest rate cut cycle. And that, my friend, is the fundamental reason for us to invest heavily in long Treasury bond ETF, TLT and TMF in 2024. If we look at the 30-year Treasury bond yield curve, we can see that the bond yield has reached a 1-year low of 3.9%. Accordingly, the 30-year Treasury bond ETF, TLT's price has reached over $101 per share, which is the highest since July 2023. Now, some investors might think that bonds are overbought in the short term, and there's risk that the bond price can drop from the current level. However, I think right now we will be seeing the bond rally as Fed cuts interest rate in the next 6 to 12 months. The bigger risk is that we sell our bond positions prematurely and miss out the opportunity of bonds to go higher and higher in price. If we look at the 30-year Treasury yield curve for the past 5 years, we can see the yield was kept at 3% or below from 2019 to 2022, before the Fed began to hike interest rate to control inflation. So we expect the 30-year Treasury yield to continue dropping from 3.9% now to 3% or even 2.5% in the future, as long as the inflation rate can be kept at 3% or below. The yield will continue to drop as Fed cuts interest rate month by month. If that happens, TLT's price still has the great potential to go even higher. Let's look at TLT's price history from 2019 to 2024. We can see TLT's price would become $115 per share when long-term treasury yield curve comes down to 3%. Now, TLT's price is at around $100, so that means we would have another 15% growth of TLT price from today's value. As of TMF, which is 3 times leverage to TLT, we expect its price to increase by as much as 50% in the next 6 months from the level right now. This is the holdings of CRI investment portfolio as of today, September 17. We can see our TLT holding has already got 3.2% over our purchasing price. And for TMF, which is our largest investment right now, has got over 22% over our purchasing price. We also have several other medium to long-term bond ETF holdings, such as EDV, VGLT, UBT, and UST, which are all increasing in their values. We will keep close attention to the Fed's progress in cutting interest rate, as well as its impact to the stock market and the economy, such that we can determine the best time to sell off TLT and TMF and secure the largest profits possible. Right now, we expect by Q1 or Q2 of 2025, the stock market may have a big crash, and at that time, we would sell most of our bond holdings and use the money to invest heavily in stock market index at a cheaper price than today. Another big news over the past week was a second assassination attempt made against GOP candidate Trump on September 15. Now, this incident did not cause severe outcome, as the Secret Service has successfully arrested the suspect in Florida on the same day of the assassination attempt. However, we can clearly see the political powers are fighting fiercely between Trump and Harris campaigns. We expect the stock market will have big turbulence in the next 2 months, as the hedge funds, Wall Street, and investors from different backgrounds will bet in favor of either Trump or Harris to win the US presidential election in November of this year. The one sector of which the price is relatively cheap for investors to buy right now is energy-related stocks and ETFs. This is because the crude oil price has fallen to the lowest point in the past year, as both US and China, the world's 2 largest economies, have decreased industrial and manufacturing activities for the past 3 quarters. Moreover, regional conflicts or wars are being mitigated, and the need for more oil and gas has gone down significantly. If we look at the crude oil price over the past 5 years, we can see oil price has fallen to the level of March 2021, and is also very close to the level of 2019, right before COVID pandemic. We think now is a great time to buy cheap into energy stocks and ETFs. We don't need to invest heavily into them, but a portfolio with 5% or 7% exposure to energy would be very beneficial. When the Fed cuts interest rate and inflation comes back again, energy and oil prices will have at least 20% growth from the level right now. We described in detail how we invested in Occidental Petroleum Company stock, as well as energy sector ETF, XLE, and IYE in August. You can see that all these 3 holdings are underwater right now. Oxy is particularly cheap in stock price and is 9% lower than our purchasing price in late August. If we look at Oxy stock price, we can find it's very close to the lowest level in a year, and it's all over 23% cheaper than the price in September of 2023. And I do think now is a great time to buy into Oxy stocks, as the price is very reasonable compared to tech stocks. We will continue to hold Oxy and energy sector ETFs probably until 2025 or 2026, when the oil price comes back again to a high point, and then we will sell these investments to secure profits. In addition, the dividends from these energy and oil stocks are really good, so we can enjoy a dividend rate of 3% while we are holding these positions, which is an extra benefit. Analysts from Goldman Sachs published an article last Friday claiming that Occidental Petroleum Corporation is a great stock that can be held for long term. Goldman thinks the application of AI tools can be used for Oxy in oil exploration and production, thus increasing efficiency and reducing costs. Ultimately, the revenue of Oxy will rise to a much higher level, and Goldman estimates the stock price will eventually go up to a range between $78 and $81 per share. Now, Oxy's price is at $51, which means it has a potential growth of over 50%. We are not that bullish on Oxy's stock price outcome, but we do believe that it has the potential to go above $70 per share. If that happens, we will sell Oxy and energy ETFs, including IYE and XLE, and we will be able to gain a profit of over 35% just in capital gains, which is very good. Of course, we will keep an eye on the crude oil price and follow up with you, my friend, on any major updates or progress in energy-related investments. Apart from energy stocks, we did purchase 110 shares of Google stocks earlier last week at a unit cost of $150 per share. Google now comprises of over 4% in our portfolio in terms of capital weight. We expect Google's stock price to go above $170 per share in October or November of this year, and we will sell them by then to secure a net profit of over 15%. This table shows CRI investment performance in 2024. We can see that we have a net gain of over $50,000 in 9 months, with a cumulative year-to-date return of 14.1%. If you followed up in our previous videos, you will know that we were heavily invested in long treasury bonds TMF and TLT, and our portfolio increased in value dramatically from May until September, with over 20% increase in 4 months. This timeline coincides with the inflation rate going down, giving the Fed more confidence to cut interest rate, which ultimately leads to continued yield drop for US Treasury bonds. If we compare our performance with S&P 500 index, we can see our cumulative return is still slightly below that of SP 500, which is at 19.3% year to date. However, our uptrend is quite strong, and we anticipate our return will be higher than SP 500 index by the end of 2024. I hope that happens. And that's the whole story of today's video. If you are a retail investor like myself and would like to know more about the US economy updates and our most recent trading activities, please give us a thumb up, share this video, and consider subscribing our channel, Charlie Retail Invest. You are also more than welcome to leave your thoughts on the stock market in the comment section below. Thank you so much for your time and support. I'll see you in the next video. Please take care.